Impairment and derecognition are important accounting concepts related to long-lived assets because they determine when asset values must be reduced or removed from financial statements. The program explains that long-lived assets may lose value over time because of technological changes, declining market demand, legal developments, or operational inefficiencies. When the carrying value of an asset exceeds the economic benefits expected to be recovered from it, impairment accounting requires recognition of a loss. Derecognition occurs when an asset is sold, abandoned, exchanged, or otherwise removed from company ownership or control. Analysts must understand these accounting treatments because they significantly affect reported earnings, asset balances, profitability ratios, and assessments of financial reporting quality. Impairment occurs when the carrying amount of a long-lived asset exceeds its recoverable value. For finite-lived assets such as equipment, patents, or amortizable intangible assets, companies periodically evaluate whether events or circumstances indicate potential impairment. Examples include declining profitability, adverse market conditions, technological obsolescence, or physical damage to assets. Under impairment accounting, the carrying value of the asset is reduced to reflect the lower recoverable amount, and the difference is recognized as an impairment loss on the income statement. These losses reduce current earnings and total assets. Analysts carefully monitor impairment charges because they may signal deteriorating business conditions, poor acquisition decisions, or overestimation of future economic benefits by management. The accounting treatment of impairment differs somewhat between IFRS and US GAAP. Under IFRS, impairment is generally measured by comparing carrying value with recoverable amount, defined as the higher of fair value less selling costs or value in use based on discounted future cash flows. US GAAP uses a recoverability test that compares carrying value with undiscounted expected future cash flows before impairment is recognized. Once impairment exists, the asset is written down to fair value. IFRS also permits reversal of impairment losses for many long-lived assets if economic conditions improve, while US GAAP generally prohibits reversals. Analysts comparing international firms must therefore understand how accounting standards affect reported asset values and profitability measures. Goodwill impairment represents a particularly important area of analysis because goodwill often reflects large acquisition premiums paid during business combinations. Unlike finite-lived assets, goodwill is not amortized but must be tested periodically for impairment. A goodwill impairment occurs when the carrying value of the reporting unit exceeds its fair value. Because goodwill valuations rely heavily on management assumptions regarding future cash flows, growth rates, and discount rates, impairment testing involves substantial judgment. Large goodwill impairments may indicate failed acquisitions, weak strategic integration, or declining competitive position. Analysts therefore examine goodwill balances and impairment trends carefully because excessive goodwill or repeated impairments may raise concerns regarding acquisition strategy, management credibility, and long-term earnings sustainability. Derecognition occurs when a company disposes of or loses control over an asset through sale, abandonment, exchange, or expiration of rights. Upon derecognition, the asset and any related accumulated depreciation or amortization are removed from the balance sheet. The difference between the proceeds received and the carrying value of the asset is recognized as a gain or loss in the income statement. Analysts evaluate these gains and losses carefully because they are often non-recurring and may distort operating profitability. Large gains from asset sales may temporarily boost earnings without improving core business operations, while repeated asset disposals may indicate restructuring, operational challenges, or shifts in strategic direction requiring further investigation. The analysis of impairment and derecognition is essential for evaluating earnings quality, asset valuation, and management effectiveness. Impairment losses often reveal that prior investment decisions or valuation assumptions were overly optimistic. Derecognition transactions may also provide insight into changing business strategy, liquidity management, or operational restructuring. Analysts therefore assess whether impairment charges and disposal gains or losses are isolated events or part of broader operational trends. Because these accounting treatments involve significant managerial judgment, they may also create opportunities for earnings management through delayed impairments or strategic timing of asset sales. A strong understanding of impairment and derecognition enables analysts to interpret financial statements more accurately, evaluate reporting quality, and improve valuation and forecasting decisions.